I'm going to start off this session really, really briefly by firstly introducing Daniel Brooksbank, who's the editor of Responsible Investor, who are kind of the go-to place for news in this area. Fantastic online magazine, loads of really useful news. It's where I get most of the stuff I know, apart from Uxif, obviously. The other thing is that I'm going to put this in a little bit of context. We talked earlier about needing to shift the dial, and my conversation around that, about how the whole retail chain's got to change what it does. But I had a thought late last night, perhaps working too late. Anyone recognise this? You're absolutely right. Man's a genius. Give him a badge. Yeah, so Friends Provident Responsible Engagement Overlay. In 2000, I was running around the country, tore T-shirts, all the venues we did. When I was part of Friends Provident, we were running around talking to people about the need to engage with companies and bring about effective change. We have a photo of ice and polar bear on the front. So for anyone in here who's kind of thinking, oh, this is new and it's exciting, etc., a little bit of context, that goes back to 2000. So that's a genuine example. This stuff's been going on for a long time, hence the need to speed up. So with no further ado, over to Daniel. Thank you.
Thanks, Julia. It's a great pleasure and privilege to be here. And I think we have, by any definition, an expert panel. And I'm going to ask the panelists very briefly to firstly introduce themselves, and then secondly, that's the easy bit, and then to, if they can, summarize where we are from their perspective in terms of this agenda and where we need to get to, and hopefully that will start the ball rolling. What I would say is I would like to keep this as interactive as possible, as lively as possible, and please feel free to fire torpedoes, bullets, Exocet missiles at any of us. From ethical Exocet missiles to us, we welcome that. I mean, put the panel on the spot if you have to. If there's any questions of terminology, I mean, it's a jargon-free, jargon-filled sector, the ESG sector. We come across this every day. Little word on responsible investors, very kind words there from Julia. We've been going about 12 years covering the institutional space, which is possibly slightly further down the track on this, I don't know. The pensions minister, Guy Opperman, quite recently, writing in Responsible Investor, said the pension trustee sector is floating on a tide of greenwash from asset managers. I'm not sure how true that is. There's people doing some great work. The work of the SDGs, work of the UN Principles for Responsible Investment. There's great work being done. There's a great lot of ESG integration taking place. But it's probably not enough to solve the crisis we're in. So with that thought, over to you, Mark.
Hi, my name is Mark Armstrong. My company is Blue Sphere Wealth. And from a young age, I've always enjoyed reading about nature, science, planets, and our place in the universe. So naturally, my early career started in corporate banking. Another realization sort of 5 years into that arena was that I was terrible at selling products and services to people who didn't want the products and services. So fast forward very quickly to about 18 months ago, and I had become financial advisor, joined my family wealth management practice, and my friend brought the topic of impact investing to me. So with my love of nature and science, and to find out that I could marry what I really enjoyed reading about and cared about with the financial planning world was fantastic. So we went on a journey of education really for about 18 months, and it was very clear that the market had changed and that we as an advice practice needed to do so. So we set up Blue Sphere Wealth in May as a dedicated impact financial advice practice. I'm not going to use any more jargon than impact. I'm going to put everything in a bucket of sustainable investing. I think we can all agree that that's pretty much what it is. And for me, it was a great realization of IFAs specifically are gatekeepers to an awful lot of wealth, and that wealth can be used for some really good things. And what has changed is the fact by events like this is ethical investing, sustainable investing as a whole is becoming the mainstream, and we need to realise that. And it's fantastic that we've got all the fund managers here, because it's great to see their stories, and it's great to see the fact that they're on board with this, because they're integral partners for not only my clients but for us. And it's how the wealth is going. We were just talking about this before. We're going to go through a huge wealth transfer over the next 5-10 years, and we need to be on board with the fact that when the wealth transfers to the younger generation, this form of investing is going to be an expectation. It's going to be the standard, it's going to be the default way of investing, and we need to change that. So for me, what has changed is, as specifically for an IFA, is the market has changed, and these issues are becoming more mainstream. And if we look to sort of what needs to change and what is changing now, is the way, I'm just going to sort of stick to my lane as an IFA, is the way that we interact with clients directly, sort of from me to Mr. and Mrs. Smith. How do we talk to them? How do we bring about these issues of sustainable investing? How do we start to open up the conversations? And it's been interesting today. We've had a few questions about how do you open up in your fact find or your initial discussions. And we sort of do it slightly differently, whereas we bring these issues to the client. Because my client, they're everyday people like you and me. They're doctors, dentists, plumbers. They're very busy with their own lives, and they may not be brought up to speed with the fact that this is an industry itself, it's growing. They might not know what the Sustainable Development Goals are. And for me, it's my job to bring that to them, because they actually do care about these issues. And if I ask a client, what's your position on child labour, they may not, it's very difficult for my client to sort of bring about that discussion. It's very awkward. But if I present to them, so the framework we use is the Sustainable Development Goals. We'll talk about that there's 17 pretty big problems that they can agree that are pretty big problems. And their money directly can make an impact on those. And it's very, very simple. Here are 2 portfolios, one we may already be invested in, and the one that I'm going to propose. I think we can all agree that the returns are pretty much similar between a traditional portfolio and a sustainable one. And the end goal for my client, whether that's going to be income in retirement or any sort of final goal, that's going to be the same. So we've got 2 portfolios, the returns are the same, they're matched to your risk, and they will achieve the end goal, hopefully, as they go through the journey with me. Your end goal will be achieved. One is having a negative impact on the planet. The second one is having a positive impact on the planet. Which one are you going to choose? And that's as simple as we make the process initially with clients. It doesn't need to be overcomplicated. It doesn't need to be complex. I don't need to bring in terms like ethical, SRI. We just very, very simply brush over introducing the topics. And then the next time we sit down with a client and we bring them on a journey from never hearing about these Sustainable Development Goals and impact investing, sustainable investing, the next time we sit down, it's an education piece from the client, from never hearing anything before, to scratching a layer deeper. Okay, now that you understand that you can have a positive impact with your money, you can earn a financial return, and you can achieve the end goal, what companies are we now invested in? What impact are we having with your money? And that's where it's important. So we use the likes of EQ and Tribe, who I know are in the room today. It's great that they provide me, the IFA, with case studies, the companies, the individual companies that my clients are investing in, because then we can storytell to say, originally we invested in perhaps industries and companies that I might not want to tell you the stories about, but now we can. We can have some really good storytelling conversations. My client knows where their money is invested. And for them, transitioning from a negative impact portfolio to a positive impact portfolio makes them feel good about how they've invested, and they've never had that before.
Okay.
So very, very briefly,
Nick,
that's me.
great opening remarks, I think. Ray, to you.
Thanks, Daniel, and thanks, Julia, for having me, and to all of you colleagues for being here. For me, I guess like Mark, I was at university and considering a few things, and then I got the call that I'll always remember from my dad saying, we run out of money. Can you pay for half your brother's education? And I never said no to my dad. Perhaps that was a big mistake. So I agreed, and he was going to the most expensive, I think, university in the US at the time. So I went to Wall Street, and I had to, make some money in order to do that. And 8 years later, I walked out, didn't know what I wanted to do with my life, came over to the UK for a year, which is now turned into almost 10, and did restudied and then found a job at WWF. So I've done quite a switch from private sector to NGO by working on sustainable finance, which is quite exciting. And I guess what has changed? I mean, clearly in the 8 years I've been at WWF, the awareness, the customer demand, and the clear policy direction on a global basis has changed markedly. So that's good. I think what is changing, as Mark and I talked about, at the moment, there's $30 trillion of wealth that will be transferred over the next 3 decades to a generation that not only cares about social and environmental outcomes, but is prioritizing those even over financial return in some cases. That I don't hear enough of that being talked about in conferences. It's absolutely a massive shift. And just from a purely financial point of view, a customer demand point of view, a client point of view, irrespective of the environmental and climatic benefits, I think one should pay attention to that. And I think what needs to change, we need to move away from the box-ticking exercises and disclosure-only based mechanisms to actually true sustainable investment.
Yeah. Mike, can you introduce yourself very briefly and say where you're coming from?
Sure. So, Mike Clark, I run a responsible investment advisory business. I've only had 3 employees in my life. I left Friends Provident in 1988, so I never had to wear the T-shirt, so I was there when they set up the Stewardship Trust. And since I was there for 15 years, I clearly left university in very short trousers. I work typically with asset owners, so I'm not that familiar with the IFA world, and I'll come to that in a moment. And I think this idea of losing the jargon, I think is really good. The ideas I was going to leave you with was the sort of value to value spectrum. So you're really getting to talk to the client about sort of money and what they believe. So is it like no tobacco, or is it climate change that used to be values but now is money? And there's also a risk spectrum, the risk to them, the risk to their money, the risk to what they think they're doing with their money, and there's a risk to your businesses. So maybe a value spectrum and a risk spectrum is just as a helpful framing. Since we're saying how we got to, I'm a Christian, so that affects how I do these things. In terms of recent stuff, I was Specialist Advisor to the House of Commons Environment Audit Committee last year for the Green Finance Inquiry. I actually sit on the Web Asset Management Investment Advisory Committee. I'm a non-executive director at Brunel, which is one of the LGPS pools. I'm working on the Just Transition with some people at LSE Grantham, so very much the sort of policy framing. Where we are is a difficult question, so I thought I'd rapidly say some things which sounds a bit like a professor giving you a reading list. And if you've all over these, that's fine, but if you haven't come across the inevitable policy response, IPR, I encourage you to Google it. It takes the Paris Agreement and looks where that might land us in about 5 years, framing global policy around climate. So there's the IPR. I could also give you a narrative about the rapid or the gradual energy transition. If you want it, get me on LinkedIn, I'll send you the slide. You could talk to your managers about their PRI assessments. That might help some of the research you do. Don't just go for the high-level thing, go for the detailed assessments. You could begin to think about carbon pricing. Carbon pricing will affect the portfolios that you're doing for your clients. There's even now political discussion about a carbon border tax. So if you're inside the EU and the price goes up, what might a carbon border tax do to American imports? So there's loads of policy stuff that might interest you. My 6th point, and in fact we've already said it, was subscribe to RI. Daniel didn't know I was going to say this, but if you want to learn about stuff, frankly, that's where I learn a lot of my stuff. And the Opperman letter, which he very recently wrote to pension fund trustees, I transcribed a few of the questions for IFAs which they could be asked by a regulator or a client or somebody. What substantive changes have you made to your business model in the last 3 years to take account of ESG and climate change? Have you made any substantive changes to your business model by taking of client views? Does your business make climate disclosures in line with the TCFD framework? Probably a bit early, but it might come. I'll stop there.
Thanks, Mike. Ben, over to you.
Thanks. So I'm Ben Constable-Maxwell. I'm head of Sustainable Impact Investing at M&G. I've been at M&G for about 16 years. and sort of coordinating a lot of our ESG activities for about the last 10 years. And I suppose, it's an area that I felt and still do feel very passionate about, but I think increasingly as the last 10 years have developed, it's an area I think that is, from an investment perspective and from a fund management perspective, made more and more sense. And what's very interesting at an organisation like M&G is that responsible investing, sustainable investing, and increasingly now things like impact investing are really capturing the imagination of fund managers and making investment sense to fund managers, as well as I think making a lot of sense to our clients increasingly, and I think reflecting the societal role that fund managers, and I suppose all of us here in this room in the investment chain, that role we recognise we have to play, and I think increasingly our clients expect us to play. But very briefly, I think what's changed, and we've touched on the key issues really, but what has changed is I think public policy really is now driving the agenda here, whether it's the UK and or other countries coming up with a net zero target, whether it's MiFID II and the implications of that. Our clients, we really think, are calling on us to do more, whether it's in RFPs from institutional investors or whether it's surveys that we conduct on our more retail direct clients. And fund managers really have moved from going back 10 years ago. It was quite a tough call having a discussion on ESG with a fund manager. Not all fund managers, but majority of the fund managers. They were good people, responsible people, thought about our clients, but having a discussion around climate change or water risk or sort of labour relations, those sort of things, was not a conversation you had with everyone. Increasingly now, that is something that is coming to our team, the ESG team. It's not just one way, it's coming back the other way. Very quickly on what is changing. I think the availability of information for fund managers, for investors, is transforming, whether it's around climate change, scenario analysis. So how is our portfolio, or how are all our portfolios positioned for different climate change scenarios? We can now do that by plugging a portfolio into a tool that tells us whether a fund is 1.5 degree aligned, 2.5 degree aligned, 4 degree aligned. Now, that's a simple output, and we have to scrutinise and analyse that data, but it's an amazing tool that fund managers have available to us. And I think the other bit that is really interesting is, we can now use sort of satellite imagery to assess whether companies' stated decarbonisation commitments are being lived up to. The destruction of the Amazon rainforest, among many other environmental issues, those are really crucial for us to focus on, and we now have the tools available to us to do that much more effectively than we did even 2 or 3 years ago. And the final point, obviously, on what needs to change, I think we just need to accelerate progress. I think we, as an investment management business, and again, as an investment industry, we need to recognise that there's good things being done, lots of progress being made, but I think we do need to accelerate that progress, because the path that we're on, with huge negative implications for investments, as well as obviously the world more broadly, we're on a 3 to 3.5 degree, 4 degree world. Now that's not a world in which the investment chain is going to be able to survive, just quite simply. So I do think we need to accelerate progress, and we as investors need to help our customers and the advisory world to navigate that direction by having good quality products and much better communication, I think, out to the advisory community and ultimately our clients.
Thank you, Ben. Julia.
So I'll be brief, but so I guess when I first started doing this, I first found out about this area from the old MPI team, Tessa Tennant, Mark Campanelli, etc. And they were the slightly strange people in the corner in head office, and me wanting to move into their team was kind of, there were 4 people doing that already. Why would you need 5? That was enough for the whole industry. So, and then here we are today. Everything has changed. The business case has changed. We've got hopefully more regulation and standards and everything coming along in every single aspect, focusing on sustainability. Just briefly, what needs to change beyond that? I don't think the urgency is there yet. You know, Extinction Rebellion
Yeah.
are making it really clear, and probably us in this room get that, and everyone else, it's kind of on the agenda and they recognise that it's no longer crazy, but they haven't, you know, it hasn't sunk in how fast we've got to sort things out. So I think that's the next bit, is getting it the next level.
Okay, great introductory remarks. I'd like to throw this open to the floor. Does anyone have any burning questions for any of these expert panelists? This gentleman at the front, do we have mics?
We've got mics, yeah.
We've
So
got roving
George and
mics.
Zoe. Go to the people with the hands up, yeah.
Gentleman here at the... Can I ask you to say your name and affiliation before the question, please?
Yeah, good afternoon, everyone. My name's Paul. I'm a financial planner with Succession Wealth. We're really struggling as a company to match individual funds, and by that I mean multi-asset space, because we're not fund pickers, to actual financial planning. And a lot of the terminology I'm hearing here is IFA, which to me is almost offensive to where my side of the industry's gone. All I've got is active fund managers here, and I'm just conscious of this mismatch, because I can't populate an ESG portfolio in the way that I'd like to populate it without compromising, without going active. And I'd just like the panel's views on that, because I believe, and I think this is controversial, that with a screening criteria, you can go ESG and passive.
Who wants to pick that up? Mark?
Yeah, I can pick that up. So it's interesting because the vast proportion of our business, our traditional sort of side, is passive investing. So we use Dimensional and Vanguard as sort of our bulk. So it's really an interesting point, is how do you marry the two together? Can we do that? Is it right for the client? Like I say, the bulk of our funds are in passive, so it's low cost, and that's been that's what we've told the client, you know. We've all talked about the interest and how much that racks up over a long period of time, the benefits of passive investing, but then I think about the larger scale stuff. So we all know that we've got these huge issues. What are we going to do about it? And that I absolutely agree with you that there is a passive active debate, but for me the issues are a lot wider than an internal debate. So what can we do as financial advisors to start solving some of the world's biggest problems? Yes, I think the debate is going to happen. I absolutely agree with your point, but I think it's something for a little bit later down the line. For me, it's more important that we take wider problems and see how we can solve them. So I hope that, feel free to come back at me.
Thanks, Mark. Mike, do you have a...
I don't know exactly where you are, but I go in the following way. I think this is firstly a business problem for you. I think you need to develop your own business's view on some of these SDG type values issues. So I think you need to know what you want. I then think you need to realise that that will involve compromise. I think clients will then have to compromise with your product choices, because effectively you are setting a product problem for the investment management industry via an index issue. So if you really want to do passive, and clearly indices in one sense are passive, but you have raised an active issue because you are heading towards value and values. We don't have a word for sort of sus active, but you're basically being active in a higher space above investment managers. So I think the way forward may involve you and others effectively telling those who supply indices and products that you have enough capital that they can bother. Discuss. That would be my...
Julia, do you want to come in on that?
Yeah, I was wondering, Ben, did you want to say anything? Are you okay? Shall I?
No,
Yeah, so I talk to all fund managers, and my view on this, as anyone here will know, is that I want all capital to shift. You know, it's not good enough to be just some of them, it's all of them. I think the passives, to my mind, are just way behind the active guys. You know, they ought to be doing a lot more, and guess what? They know it, because I talk to them behind the scenes. Actually, some of them genuinely think they're amazing, and they're just not. Sorry, this is on video, bad comment. But you know what I mean. They want to do the right thing, some of them, but for various reasons they're constrained. They've got their models that they've got to stick to, and they don't get it. You know, they've got to actually take that leap in their heads that says, actually, in order for us to do something different, we've got to do something differently. We've got to change. and sticking to the pure passive strategies that they've got, you know, that they will get there, but they're a long way off.
And their models need to be challenged by your business view, because you own that view, and their models are simply a market response you have not changed yet. So the ball is in your court a bit.
Yeah, definitely.
Balls
Can
in
I-
your court.
Can I see if there's any other people want to come in on that question, because it's a massive question. Zoe, do you want to come down to Ray here, second row?
And the lady behind. Oh, and there's a
And,
lady there.
yeah, and Jill. Yeah.
Yeah, thanks for that, Julie.
Sorry.
Again, on video. Rick Belcher from Chase DeVere. I mean, just on that sort of passive versus active, my own experience of dealing with Vanguard for the SRI funds is that they, in my view, they are gearing it so much to keeping the costs down that the level of screening that they put on there is so vague. We had a dig down through and they were still letting certain tobacco stocks through in small numbers. So if they're letting just something as basic as that through the screening, they're not fit for purpose at all, and you pay for active.
Could I add a quick comment maybe
Okay.
just on I think there's this kind of spectrum of available options available to responsible and sustainable investors, and I think screening is absolutely a valid part of it. And going to Mike's point on values to value, you know, I think it is a good way to align relatively simply your values with your investment kind of products or your investment. I think it really leaves out, though, all of the kind of value that can be generated as a fully integrated ESG fund manager, where you're actively making investments in what you think are the best businesses from an ESG and investment perspective, or businesses that are changing, when you can use your active engagement to encourage those companies to change. And also, I think it is a question of, you know, focus. So an active fund manager with a 30 stock, 35 stock, you know, positive impact portfolio can have an enormously different sort of engagement with those companies, focus on the best businesses, focus on the solutions providers than I think a screened passive fund has. And to Julia's point, I think there's scope and need for integration of sustainability thinking right across the spectrum, but needs to be a recognition about the different role those different funds and those different strategies can play.
Lady at the front there's got the mic.
Yeah, to add to my colleague at the back there, I'm a financial planner as well, and I think we've got a double layer. We've got our financial planning to do, the tax wrappers and all of that, as well as what goes inside the tax wrappers, the investments. And there's an awful lot of pressure on us to do suitability reports, risk management, risk-targeted funds, and you lose sight of the good stuff that's inside the sustainable and the ethical funds. So I think there's the pressure on fees, because you've got the fund manager's fees, you've got the platform fees, and then you've got your own financial planning fees for being the conductor of the orchestra. And there's a temptation to go down the passive route to replicate the larger markets, but we lose sight of the stories and the good stuff. And I think if we can have time in our practice to talk about the stories and the good stuff, people will pay those extra basis points for proper active and engaged management. And fund managers can do some great stuff if they're engaged and fully active with the companies they invest in.
Anyone else want to come in on that lady there? Sarah, yes.
So I only really in the last year or so have got down into the weeds of index creation. That's largely because I've got a new shareholder who does custom indexes. And Julia and I have talked about this, is there's often this kind of like big box mentality of, oh, you go and get an index from so-and-so. But actually technology and the availability of data is really changing the dynamic now. And I've just been sort of let into a world where people are creating all kinds of fantastic strategies, which are low-cost index strategies, but they're kind of like active index, in that the fund managers are actually bringing their particular insight and expertise and saying, well, now I reject that model, because that model was created maybe 25 years ago. There's new stuff coming out. There's more data, more frameworks. So I would just say, don't despair. But yes, there are other options available, and yes, some of those screens, they are a bit feeble as the best way, the politest way, but yeah, other sources are available.
There's quite a lot of questions, and arm up at the back there.
Thank Thank you, George. Just coming back to what was being said about the passive versus active debate there, is that, and mentioning about Vanguard as one of the options, quite accept the fact that the Vanguard proposition is just following the UN principles, which we've always explained to clients is purely and simply avoiding the illegal rather than the immoral. As a result of that, our approach when the Vanguard Life Strategy funds came out in the first place was we actually gave our clients the option of actually running with the Vanguard SRI funds, and we simply actually matched those to the life strategy with bonds. Consequently, once clients better understood SRI and ESG in general, we don't actually have any passives anymore. It's all moved across, and probably 98% of our clients are actually using an ESG overlay. We did say to Vanguard at the time, it'd be very simple for them to have actually approached it with a life strategy approach with their SRI funds as well. So it can be done with passives, and it can actually have a wider impact, which is what we're all talking about, a wider impact to the general public if the approach is to accept that we just want to mirror what is actually being offered first of all, and then move people to a more positive way. You can't do things overnight, which is what has been said here from the start, is we're talking about 20 years of improvement here. It's not just 1 year. It's 20 years of improvement. It's got to be done in stages. It won't happen overnight. So there you go.
Very interesting point. Is there anyone here from Vanguard? Does anyone want to pick Ray? Do you want to pick that up?
Yeah.
It's been some interesting points. Thanks.
It is a good point. I think let me just pull an analogy, I guess, because if you look at what's happening with electric cars, you know, the argument was made that we'll do it in stages. Now, of course, we don't have unlimited time, and the urgency point has been raised by several people. We'll do it in stages, so people will get, you know, the hybrid, and then, you know, potentially the plug-in hybrid and the extended range hybrid, and then go fully electric. That's the theory. Well, that theory hasn't worked because people switch to potentially the hybrid and they stop. Right? Why? Well, because they're afraid of range anxiety. You know, they don't want to then do something else. They've already ticked that box. Whatever it may be, that's what you're seeing in the market. So you're having about 1% of cars be pure electric, and the rest are carrying around the ICE, the electric stuff, and all the stuff to connect both of them. And actually, if you run on the motorway, you go through electric range very quickly, and then you're causing more damage to the planet. So I think that analogy can apply here, because you cannot have, irrespective of the reason being fees or whatever the reason is, you cannot have a planet-aligned or ESG or sustainability strategy that is destroying the planet. That is mis-selling. And this stuff is going to get called out more and more as now people are more aware. So I don't think that we have the luxury of time on this issue to be going in those stages. And that's not what the evidence is showing. So I think sometimes maybe you need to spend a bit more time up front and make the leap to something really sustainable. But I know it's contentious.
Yeah. Mark, you wanted to come in?
Yeah, no, it was just sort of a clarification point. We are actually moving away from the likes of passives and putting our money into active strategies. So I absolutely agree that the likes of Vanguard and Dimensional, like you said before, sort of the lenses haven't been very good. We're moving and transitioning people out of those strategies and into positive impact strategies, because it's really, really important that we do that. And the debate between active and passive, for me, it can go on and on and on, but at the end of the day, what's important is my client and my client's money and the impact that they can have. So moving from one strategy to another, that's fine if it's right for the client, and we're actively moving money away from that passive market now and actively investing it into those active fund managers.
Mike, you wanted to come in?
Yeah, we need to move away from the active-passive debate. Active-passive is solely an investment manager construct. Mm-hmm. We need a word for whatever this thing is up here that asset owners and your clients are doing. I use SUS Active and SDG Active, which are really appalling. I've also tried to introduce the phrase strategic risk allocation into my institutional world, but SRA is another TLA, another three-letter acronym before SAA. But we need a way of describing that, because it's basically taking the sort of SDG stuff and letting that frame our thinking. I think Vanguard might be surprised if in your product development conversations with suppliers you say, you know, maybe nobody said this to you before, but we would pay 3 more basis points on that thing because we want things. So I think part of your product development conversations with your suppliers is realizing that passive is cheaper, and if it's fairly model-based. You can look at what the HSBC pension scheme did 3 years ago with Legal & General FTSE Russell. So they put 2 billion in something that took 18 months to build, which effectively is a climate-savvy sort of passive but active at the pension scheme level. So there's lots of things out there which, if you're not familiar with, I encourage you to go find, which will sort of teach you that in many ways the institutional world has sort of done this first. And the final point is, you probably find Vanguard are absolutely riveted on tracking error. But in fact, if you are beginning to say to your clients, yes, I understand your view of the world is like this, not like MSCI World, then actually tracking error to MSCI World is totally irrelevant. I caught a great climate investor activist supporting the new European Union climate benchmarks. And then she said, but the trouble with it is, there's a big tracking error against MSCI World. Now, if your investment beliefs are over here, so I think you get the point.
Interesting. We are running very short on time, so this is a quick fire round. One question, and keep it brief, please. Gentleman here, just next to, right there with the glasses. Okay, the lady there. Okay, you've got the mic.
Hi, Mathilde from Vintage Asset Management. I was just wondering what your thoughts were on, do you think that there's a collaboration issue within the financial industry? And if so, is it impeding on progressing in the ESG?
You mean a lack of collaboration?
Yes.
Yeah. Ben?
I think historically there was definitely, the industry was set up in a sort of competitive dynamic where it's all about alpha, who could outcompete who. That was very much the approach that the fund management industry took. I think from an investment perspective, that's still kind of essentially there. But what is really fascinating and encouraging is that in the sustainability ESG sort of impact space, there's a huge amount of collaboration taking place between institutional investors and fund managers. There are organisations like Climate Action 100 Plus, where I think it's $35 trillion of the world's biggest investment management assets are working together to call on the 100 biggest and a few others biggest emitters to set decarbonisation plans and really transition to the low carbon world. So that's one example of a very, very collaborative, pretty active, and I think hopefully will be very successful initiative. I think collaboration is happening more and more, and I think it's been driven by this sort of collective responsibility view that ESG and sustainability has promoted. So I'm encouraged. I think we could probably collaborate more on the big issues, but I think there's a lot going on already.
Yeah, certainly I'll chime in with Ben there. The institutional space is really, there's so much collaboration going on with the PRI, Climate Action 100, as you say. It's a real feature of the institutional space because a pension fund is not competing with another pension fund, broadly speaking.
But the investment managers are.
The investment managers are, but they see it as a benefit in working together for their clients. So that's one of the issues. You have a huge pension fund. It's not in competition with another.
I have a collaboration recommendation. I know nothing about the IFA world, but I assume you have some trade organisations. So one thing you guys might want to do is make your trade associations a resource base you can draw on for this stuff, because there is so much going on, and I just tried to touch on some of it, that the more you could find a way of having a central resource base, I just wonder if that might help you, or it may be an appalling idea.
It's work in progress. Can I ask how many PIMFA members there are here? Okay, a few. Not enough. You need to work with other groups as well. But PIMFA on the case.
Fine.
Okay.
So not stupid.
Great.
No, that's a good question.
Listen, I think there's a lot of food for thought here. I think we could have a few more questions. But in the time being, I'd like to all thank this expert panel. Thank you very much.
Thank you.